Hi, everyone. Welcome. Thank you for joining us for AAFCPAs 2023 year-end webinar covering tax compliance and advisory for cannabis businesses. I'm Pat Hegel. I'm providing some support throughout the webinar. I'll be launching and read our first poll question for today. And as I do so, I'll turn this over to Dave McManus, leader of AAFCPA's Cannabis Practice.
Thank you, Patrick, and good afternoon, everyone. We appreciate you taking time out on your busy schedules to attend this webinar. As Patrick mentioned, I am AAFCPA's Cannabis Practice leader and founded our Cannabis Practice back in 2012. And I'll be moderating today's session. And I'm going to answer my poll question too. We have a bunch of things to go over today. We are very happy to be presenting this year-end tax planning strategies for cannabis businesses. As you all are aware, the industry between IRS Code Section 280E and just the state regulations, all the regulatory requirements in this industry always put a substantial strain on our operators and their ability to generate cash flow to sustain operations. And I think you've all seen in a lot of the markets, the market saturation has continued to really just compound to this strategy and compound to this saturation and cash flow issues that we do see in this industry. So we're hoping that today's seminar will give you some good strategies and ideas to think about as you approach year end. And with that, I'm going to kick it off with our first presenter. And actually, I'll have folks introduce themselves and we will kick off with our first session.
Thanks, Dave. I'm Tomas Puello, one of our tax managers in our cannabis practice. I'm very happy to be here with you guys.
Hi, I'm Janice O'Reilly, a partner here at AAFCPAs. In addition to cannabis, I'm also a partner in our transaction advisory group, and I work with mergers and acquisitions, cannabis and non-cannabis.
Good afternoon. My name is Dave Gravel. I am a tax director in AAFCPA's Cannabis Division, focusing mostly on tax compliance and overall tax consulting.
Good afternoon. I'm Josh England. I'm a tax attorney and partner at AAF. I generally work with our cannabis clients on startup and exit strategies.
So thanks you for all of our panelists, and thanks for those who are attending this webinar. I'm now going to turn things over to Tomas to go over the first session.
Thanks, Dave. So I'll get us started this afternoon going over Internal Revenue Code Section 280E. I'll refer as 280E for simplicity purposes as much as I can during this presentation, but this code section is very relevant for our industry. And if we're being honest, if it wasn't because of this code section, this training will be going a lot different. So let's start with a quick overview for some of the new faces in the room, but we'll be covering 280E, its origin, how it impacts our business, and some planning considerations around it. As you know, some of us may not really like 280E. We can't really avoid it. We can only minimize it to a point. So let's start from the beginning. 280E covers any drug trafficking that is prohibited by federal or state law in which the trafficking is conducted. And this code section was passed by Congress in 1982. And essentially what it does, it prohibits taxpayers from claiming deductions or credits for any amounts paid or incurred in an illegal trade or business. So this code section applies to any drug listed on Schedule 1 or 2 of the Controlled Substances Act. And as we may know, cannabis is listed on Schedule 1 of the Controlled Substances Act. This also applies for both medical and recreational, regardless of the legality in which the state the business operates in. And in addition, there are some arguments out there that say that 280E wasn't really intended to be for medical purposes, but courts haven't really accepted this argument at the moment. And then ultimately, 280E doesn't prohibit taxpayers from getting a return on their capital, which is essentially your cost of goods sold. And how this works is cost of goods sold is not considered a deduction. It is considered a return of your capital. So some taxpayers can offset some of their gross income against it. So you'll get your gross income, subtract your cost of goods sold, and essentially you'll be getting taxed on your gross profit. And we'll be discussing during this presentation some details regarding cost of goods sold and how important it is in this industry. And so we'll transition. So how does 280E really impact our businesses? Trying to move this. I'm trying to do the next slide. Yeah, here we go. Thanks. So how does 280E impact our businesses? So as we mentioned earlier, businesses cannot take any ordinary expenses under 280E. Therefore, this creates a higher effective tax rates for businesses. And this could be very stressful down the road because now you have to do more planning around any outstanding or expected tax liabilities. And in fact, we've seen some cannabis operators with an effective tax rates of 3 times higher than a non-cannabis business. So if expectations are not set from the beginning, this could really affect your business. This also precludes your business from investing or reinvesting your profits back into the business, which could also bring potential issues down the road because now you're trying to manage a tight cash flow or you're not growing as fast as you want to grow. So just having a well-structured business plan or model will go a long way from for your business to grow. And then obviously obviously making sure that you're working with your trusted advisor to manage those decisions and to build that proper business model will really go a long way from an operational and a tax efficiency standpoint. Then ultimately, cost of goods sold is fundamental in this industry to minimize any 280E exposure. And I also know that Janice will be covering this from a operational standpoint, but cost of goods sold for tax purposes needs to be in line with your internal books and records. And you'll hear this from us at all times. Consistency between your books and your tax returns and your tax records are key in this industry. And then I think this drives well into my next slide from a planning standpoint and how we can really maximize your cost of goods sold at the end of the year. So I'll give you some ideas on how you can operate your business efficiently from a tax perspective. And one of those is having strong financial reporting and an accurate inventory costing methodology. This will require taking a closer look to your internal books and records, but making sure all the accounts are classified accordingly and truly reflect the cost of your product. For example, it could be allocating rent, payroll, taxes, and some indirect costs in some cases up to your cost of goods sold. And then at that point, it'll translate and it'll transition into your tax liability at the end of the year. Another one, again, it would be consistency, and consistency with your books and records are key when becoming tax efficient. We typically don't like to see a lot of book to tax differences when preparing your tax return. Therefore, just making sure the proper cost is included as part of your inventory number for book purposes will go a long way when becoming tax efficient. Because at the end of the day, if we're going to take a stand on your tax return, these calculations really need to be supported by your internal books and records, and any major book to tax differences, unfortunately, will trigger a red flags with the IRS, especially if those differences are lowering your taxable income. So strong record keeping and accurate financial statements are key to maximize your cost of goods sold for tax purposes in this industry. And then just to cover them briefly, There are two separate methodologies when calculating inventory and cost of goods sold that the IRS will allow, depending on whether you are a cannabis producer or a seller. The IRS heavily relies on Internal Revenue Code Section 471 when determining allowable cost when it comes to inventory and cost of goods sold. So if you are a cannabis producer, meaning a cultivator or a manufacturer, the inventory calculation can include raw materials, direct labor, and manufacturing overhead. On the other hand, if you're a retailer, the only allowable cost that would get factored into your calculation would be the cost of acquiring that product and any delivery or freight in that was required to get that product into your store. So the options are limited there. And then obviously just making sure that you're working with your AAF trusted advisor, as these rules are typically very different and complicated, just depending on, in which state you operate and what kind of business you're running at the end of the day. And this is, I believe this is a good stopping point to launch our next poll. And I'll also take the opportunity to get Dave's thoughts in case he has anything to add on this section or to something to reemphasize. And we'll take it from there.
So the poll question, while you all answer this, I want to just emphasize a few things that Tomas talked about. One is he mentioned in one of his first slides minimizing the effects of 280E. And, in this industry, it's very important. You can't skirt 280E. 280E is here, it exists. And unfortunately, it has a significant impact on our clients and their ability to sustain operations. Again, in this, challenging industry with a lot of market saturation and pricing compression. So 280E is here and it exists. And one of the things that we as accountants need to do is to minimize the effect of 280E. So that's what we spend our time doing. The other thing is, Tomas in his last slide mentioned the code sections 471, which provide guidance for inventory accounting. And there are two key provisions within 471 that guide the costing around retail operations, as well as costing around manufacturing, whether that be cultivation or manufacturing of products, edibles, and items like that. There is a code provision 471C. I'm sure folks have heard of it and are familiar with it. And that provision is a exception for small business taxpayers that typically have less than 26 million of annual sales to be able to provide inventory costing methodologies that are consistent with books and records. And I think that's one thing that you'll hear from us, consistently throughout this presentation is consistency between your books and records and what ultimately gets on and gets reported on your tax return. So 471C provides for a ability to move into cost of goods sold for even retailers, costs that may not be normally deductible under 471-3, which is the provisions that retailers need to follow. And as Tomas pointed out earlier, it's just really the cost of the product and the cost to get the product into your dispensary. So, we do take a position with 471C with our clients. The key is that you need to have a consistent methodology between what is in your books and records to what ultimately gets on your tax returns. You can't have differences in the books and what ultimately gets reflected in cost of goods sold, because again, as Tomas mentioned, any book to tax differences that are showing up on returns are just going to raise a red flag with the IRS. So those are the two things that I did want to cover in this session here, and we're going to turn things over to Janice O'Reilly to give more of a perspective from an accounting standpoint.
Thank you very much, Dave and Tomas. So we'll move on to the next slide. where we're going to again emphasize the consistency piece. And what does that mean, and how do you go about gaining consistency? So we have about 150 or so clients nationwide. So we have some best practices that we've pulled together, and I'd like to go over some of them with you. The first part is really making sure that the chart of accounts is set up to properly classify between cost of goods sold and operating. And when you're doing any sort of allocation, so let's take into account maybe rent or utilities or something that perhaps you're allocating based on square footage. We have found in IRS audits that it's really important to have documentation. We typically are using square footage, we're using a floor map, doing allocations based on that. And again, they have to be consistent. You can come up with your methodology, but make sure it's consistent and that it makes sense. Same thing with payroll. There are some people that perhaps work on cost of goods sold. They also work on SG&A, sales, general and administrative. So we want to make sure that if they are splitting their time, that you are doing timesheets, again, supporting whatever allocations may be there. We've heard in the industry that it's not a matter of if you'll be audited, it's when you'll be audited by the IRS. So again, we want to make sure that you're very well documented in the position that you're taking with regards to allocations. There are other things that we want to look at, for example, fixed assets. So if you have bonus depreciation isn't allowed for tax purposes, so we want to make sure that you're properly classifying between cost of goods sold and operating any equipment that you might have, or any leasehold improvements, or anything that would be capitalized. And then we want to go further and make sure that you have not only the right classification, but that you have the right life assigned to it. We've found, and we'll talk a little bit more about this later, but that cost segregation studies can come in and make sure that you have the appropriate life and that you have the appropriate classification. So those are some tricks that we've seen that really work. And again, document, document, document. Inventory costing is another area that we've talked quite a bit about. We want to make sure that you're documenting, again, why you've chosen to put in some indirect costs, for example, and having support for that and being consistent year over year. On our next slide, I'm going to talk a little bit about how we can help. You'll hear me say, use an accountant that doesn't dabble in cannabis. And we really stress that because it's complicated state to state. There's a lot of regulations that go along with it. Cash flow may be tight. There's a lot of areas that are very cannabis specific. So we want to make sure that you're focusing on your business. We can right size, or other outsourcing groups can help right size your finance function, and that we're helping you to allocate and support any of the complexities relating to 280E accounting. So lastly, I want to stress ways that we've also been able to come in, not only have support, but then take a look at things from an analytics perspective. Cash flow, as I mentioned, can be really tight. We've seen clients that are tight from cash perspective to pay taxes, as well as any distribution. So depending upon what type of entity you are, you may be doing distributions to your shareholders or members, or you may actually be a C Corp and you're filing as a C, and you're required to make estimated tax payments. As Tomas pointed out, you can have some very high effective tax rates that maybe aren't generating the cash flow to support the taxes. So we really want to make sure you're doing cash flow projections and that you're planning out for any cash payments or any other outlays for fixed assets or any other capital purchases. Budgeting can really help with that. And you can look at, staffing, energy, all of the things that are very expensive for you. One of the big areas, obviously, is inventory. And one of the next bullet talks about metrics. We use metrics and analytics quite a bit to help our clients understand what inventory they're carrying. Should they be carrying that inventory? How quickly is it turning? We also like to look at sales data. Before the tax returns are filed or before you actually finalize your financial statements for the year, we look at anything unusual. How do your margins look compared to how they were previous quarters or previous years? Again, we want to make sure that there's nothing unusual between your books and your tax filing. As we mentioned before, any kind of book to tax is going to be analyzed. So we really try to use metrics to take a hard look at very important items that are going into cost of goods sold. And then lastly, we take a look at benchmarking. We have some industry data that's out there. We also have a lot of experience with other dispensaries and MSOs, and we try to look for anything that might seem unusual and really benchmark against your peers. So those are some ideas that can help keep the consistency, as we keep stressing, between your book and tax. So with that, I will launch the next poll question. When you think about your finance team's compositions and capabilities, do you feel like they match up with your company's strategic needs?
And while folks are answering the poll question, I just wanted to bring up, one comment about the budgeting and cash flow projections is just to have realistic cash flow projections and budgets. We have seen instances where operators, because of the just the change in the industry and the saturation that we're seeing in various states and the market compression, that they just need to take a fresh look at their cash flow projections and budgets, because they may not align to what's currently going on in the industry. And then also with that, just the distributions and or tax payments, do the cash flow projections line up so that they provide a reasonable expectation to an investor, for instance, that there might be cash flow available for them to be able to make their own personal tax payments, if the entity is a pass-through company. So we have seen instances where the cash flow just isn't there for the members to make their tax payments. And the sooner that expectation can be laid out to the investors, the better things are for everybody. So with that, I'm going to turn over to the next section of the webinar to Dave Gravel, who will be going over some tax compliance items.
Thank you, Dave. Good afternoon, everybody. I will be talking about everybody's favorite topic, and that is tax compliance. So I'll do my best to make this as interesting as possible. So first and foremost, I think one of the biggest components here to understand is making sure you have a good handle on your corporate structure, and a few things go into that. Understanding if you are a partnership or a corporation. Those are the two primary tax filing statuses that we recommend in this industry. Making sure you have a good handle on that will impact what your tax returns are that you're actually filing, what your tax deadline is, as well as overall investor relations. You'll want to set the expectations up front, early and often with your CPA as well as your investors, so that everybody is on the same page. If you are a partnership and planning on giving out K1s to your members, make sure your partners know whether or not you plan on filing a tax return on time, or if you're going to be going on extension, so that the members know what to expect for their personal tax filings. How is your business set up? Are you vertically integrated, or do you have multiple entities for your business? If you're doing multiple operations, are you on one operation, or do you have multiple entities? Make sure you know who the ultimate taxpayer is. What company is reporting all of this activity, and how does it roll up to that tax reporting entity? If you have a partnership that is maybe controlling your cultivation or your manufacturing, if that partnership is owned by a upper tier partnership, a parent company, Well, that lower tier doesn't have a tax filing requirement because it's what we call a disregarded entity. And that activity will flow up into the operating activity of the overall parent. So that is where that activity will get reported. But conversely, we have corporations that even if they do have one shareholder, a corporation is considered a second legal entity. It will always file and pay its own taxes. You also want to have an understanding of how your accounting is set up to kind of get back to what Janice was talking about, making sure that your financial records are accurate. But how are they set up? Do you have more than one instance of QuickBooks, or if you're using QuickBooks to keep track of your operations, or do you have one QuickBooks file for all of your companies? Depending on how you answer that question will impact not only the complexity of your taxes, but also what files that you would be needing to provide to your CPA to manage your tax compliances. We'll talk about a couple of other taxes as well. I think everybody is very familiar with income taxes. So I don't really want to cover income taxes here. I'm going to talk about a couple of the other taxes that we need to worry about. First and foremost here is payroll taxes. Payroll taxes are a big deal in any industry. And as your business grows and you go into multiple states, you'll have to worry about payroll taxes in those states, especially if you're having employees in those states. So payroll taxes are what we call fiduciary in nature, meaning you are acting as a custodian for the tax authorities. You are responsible for withholding the payroll taxes from your employees and then remitting it to the taxing authorities. So seeing as you're holding on to somebody else's money, there's a lot of risk here, and this risk can be passed down to the owners of the company. So if you're not making your payroll taxes in a timely manner, the tax authorities can come after the business as well as the owners of that business. So it's something to take seriously. Given that amount of risk, we always recommend working with a qualified cannabis-friendly payroll provider in this space who can help you with all of those tax filing requirements. Most states will have some kind of sales tax that you'll need to tackle. You want to know how the state taxes your sales. Most states, if they have a medical program, probably will not subject medical cannabis sales to their state level sales tax, but adult use will most likely be subject to some kind of sales tax. Again, the sales tax, very much like the payroll taxes, are fiduciary in nature. So the sales tax gets withheld from the customer at the time of sale, and then you need to remit that to the taxing authorities on a regular basis. So making sure that you work with your internal finance team to make sure that those sales tax compliances are being done in a timely manner. AAFCPAs can help you with that in that area. We do have a very robust state and local tax department that can help you understand and navigate those complexities. Most state programs also have some kind of excise and/or maybe even local taxes. So just understanding what the additional excise taxes there are on any of your cannabis sales, as well as whether or not any of the local municipalities are actually imposing a local tax. I know Vermont, for example, has the ability to impose local taxes. Overall, if I have a very general kind of takeaway from this, it's two things. One is to not fall behind on paying these kinds of taxes. Most of these taxes, actually all of these taxes that we talked about, are fiduciary in nature, meaning you're holding on to them for somebody else. So making sure that you're making those payments in the required manner is extremely important, because once you get behind, it's very hard to get ahead. And falling behind on these kinds of taxes can cause a lot of problems for you. It can result in the state maybe not renewing your license, and which would cause huge problems with being able to run your business. The other thing it can cause problems with is, you might be looking to exit this industry and maybe potentially sell your business. Well, if you're working with a potential buyer, that buyer is going to have some reservations if there's a lot of unpaid taxes that need to, be dealt with. So perhaps it could slow down or stall the discussion altogether. Moving on to with our multi-state tax compliance, I want to bring up everybody's favorite topic, 280E. Tomas talked about 280E earlier at a very broad level, but I also want to make sure that we talk about it in the sense of the state taxes. So most people assume that just because if the cannabis is legal in the state, that they don't need to worry about 280E, and that might not necessarily be true. Legal does not necessarily mean deductible. So work with your AAFCPAs partner to make sure you understand how the various states comply with 280E. Most states will comply with 280E unless the state governments decide that they want to take a different position. And if that happens in a process that we call decoupling, then the state government say, you know what, we understand that the IRS is going to follow 280E, but we have a state legal program for cannabis sales, and we're going to allow these businesses to deduct all of their expenses. So really have an understanding of how the multiple states that you may or may not be operating in follow 280E. If your state does decouple from 280E, make sure you know when it takes effect. That'll be important. As more and more states kind of decouple, you'll want to know when these deductions can start being deducted. In our experience, most states that have decoupled have actually gone back. They've been retroactive. So if they were decoupled during, say, 2023, then it would go back to 1/1/2023. I've got a couple of notable states that decoupled during 2023, that being the state of New Jersey as well as Maine. So it's good to see that some of these states that have younger cannabis markets are really decoupling from 280E early on, whereas states like Massachusetts kind of took their time and took almost 10 years to decouple from 280E. That happened in 2022 for Massachusetts. Speaking of 280E, here's an illustration of how 280E stands in the United States. This map is more for reference rather than a discussion. It just shows how the various states treat 280E, not necessarily whether or not they have state legal cannabis programs. So I want to make sure people understand that. This map doesn't show whether or not the states actually have cannabis, because 280E exists outside of the cannabis industry as well. It's not, 280E applies to all illegal activities, not just cannabis. So as your business continues to grow and expand, things to keep in mind are how you create efficiencies. How do you reduce some of your overall costs? Because as Janice pointed out earlier, cash flow is so important. So how do you preserve some of that cash? So we have a couple of strategies that we've seen work in this space. So think about centralizing both your payroll as well as your accounting. Can you create some efficiencies here? If you have multiple operations in multiple states, consider having one centralized finance team that can do all of the accounting for everything, rather than having separate accounting and finance teams in each state. Payroll is another great another function that could be centralized. Talk to your payroll provider, see if it's possible to have one company process the payroll for everybody all throughout the country. If you're operating in multiple states, it is possible. Another powerful option you have is what's called group purchasing organizations. And these are organizations that really benefit folks by taking advantage of economies of scale. It's a situation where you have a few folks coming in to work with these organizations to acquire a lot of their non-cannabis products. So things like your supplies and other products that you might be using in your business that aren't related to the THC. So really getting those economies of scale can help save you some money. And then last but not least, I'm sure everybody has heard of ESG, or environmental, social, and governance programs. So, a lot of states will offer these energy incentives and other rebates for equipment purchases and machinery purchases. So again, another way of getting some of your money back and incurring some savings if you are looking to purchase maybe some energy efficient equipment or something like that. At the end of the day, what we're trying to do is make sure that you as the business owners are focusing on what you do best, and that's running your business. You want to make sure that you are right sizing it. Do you have the right people on the right bus, all going in the same direction to create these efficiencies? And one thing that you might want to recommend is possibly outsourcing some of these activities. So that'll bring us to our next poll question. Dave, do you have anything to add about these couple topics?
Thanks, Dave. Yeah, just a couple of things. Dave mentioned taxes in one of his earliest slides, and particularly property taxes or excise tax. Just keep in mind that if there is taxes that you're paying, property tax or excise tax on equipment that may be related to your cultivating activities, those taxes can be deductible under 280E. The key, though, is that those costs, those expenses are captured within your internal books and records in cost of goods sold. You can't reclassify them from a tax expense that's down in SG&A up into cost of goods sold. So again, it just comes back to consistency in how you report internally, and just keep in mind that those expenses will be allowable under 280E under the provisions of Code Section 471. The other thing is that, with the decoupling that's been happening with a lot of states, what we're seeing is that is more valuable nowadays is a cost segregation study. We have recommended cost segregation studies for a lot of our cultivators because it does allow for shortening the life of assets. So a study can be done that basically can break down the components of all your build out costs, and you can move some of those costs into shorter lives. And Janice mentioned that you can't take bonus depreciation in this industry. So you can't accelerate depreciation, but you can shorten the lives of those assets. So, as more and more states decouple, we do see this as a valuable tool to potentially consider for your dispensaries as well, because you can take those deductions on the state side and recoup and save some taxes in that manner. So with that, I'm going to just pass it back to Dave to go on to some tax credits that he'll be covering.
Great. Thank you, Dave, for those additional insights. So as Dave mentioned, I will be talking about some additional tax credits that you might be able to take advantage of. Ways to not only reduce your overall expenses, but how do you get some money back on your taxes? So there's three that we're going to look at, and those would be the research and development credit, the investment tax credit, as well as the employee retention credit. So first and foremost with R&D, the R&D credit is a dollar for dollar credit that encourages taxpayers to design, develop, and improve products and processes. The overall improvement doesn't need to be revolutionary, just evolutionary. So as long as the activity improves your product or process, it doesn't need to be for like the whole industry as a whole. For your business alone, it could qualify for the credit. This credit is driven by three main factors, those being salaries of the folks doing the R&D activity, the cost of supplies utilized in that process, as well as any payments to contractors that you may have be working with to do some of the R&D studies. So because of 280E, the R&D credit unfortunately is not available at the federal level. Remember, 280E applies not only to expenses, but it does to credits as well. So the R&D credit that we'll be talking about is referring to state level credits. So that being said, the credit can only be claimed in states that have decoupled from 280E, because otherwise they wouldn't be allowed. So even though there are over 30 states that offer some kind of R&D credit program, there's really only 14 states that fit into, a sweet spot, the trifecta, so to speak, and that's states that have some kind of state legal cannabis program, states that have decoupled from 280E, and states that offer an R&D credit. And I've listed them out here. So, if you're doing operations in these states, these are opportunities that you might have to reduce some of your state taxes. This is a credit that is very technical in nature. We would highly recommend working with a R&D credit specialist that'll come in and take a look at your business, understand your operations, and help you understand, whether or not your activities would qualify for the credit. The investment tax credit, I'm gonna shift a little bit more towards Massachusetts for the moment, because this is a Massachusetts specific credit, but I still think it's one worth pointing out. It's a credit that applies to corporations that engage in manufacturing and/or agricultural activities. So, I think if you have a manufacturing facility or some kind of cultivation facility, this is a credit that could apply to you. And basically, it encourages taxpayers to invest in tangible property, think machinery, equipment, leasehold improvements, things like that. And it encourages them to invest in those kinds of property. It amounts to a 3% credit on your current year additions. So essentially, it's $30 of credit for every $1,000 you spend in qualifying additions. And most property will qualify. It's just got to be used in that manufacturing or cultivation, business. And pretty much all building structural components, machinery, equipment, lighting, or manufacture the trimming machines, things like that. The biggest limitation is vehicles. Vehicles do not qualify for the credit. And then last but not least is the employee retention credit. And I'm sure everybody is very familiar with this credit. It's been in the news quite a lot lately. So the ERC is a holdover from the COVID-19 pandemic, and was instituted by the government to encourage businesses to keep people employed throughout the pandemic. So because the ERC is not an income tax credit, but rather a payroll tax credit, it was one of the only credits that a cannabis company we felt could take advantage of, because it wouldn't be subject to 280E. So we advised a lot of our clients to explore it further and determine whether or not they would qualify and or benefit from it. So in order to qualify, there are two ways to look at it. One was there had to be a significant decrease in sales, from pre-COVID to during COVID. If you didn't meet the sales analysis, there was another way that you could qualify, and that would be you must have been subject to some kind of government mandated shutdown, whether that be a partial or complete shutdown. So determining whether or not you met the shutdown requirements was really a facts and circumstances situation in a very gray area, and opened up to a lot of interpretation, which meant that early on in this process, a lot of companies popped up, mainly not some kind of marketing companies, seemingly overnight sometimes, advertising that everybody qualified for the credit under the shutdown provisions. And they would, say that they'll file your applications and take a fairly steep percentage of the overall credits, and sometimes upwards of 25% of the credit. And then unfortunately they took their money and ran, and very often, some of these companies were disappearing and possibly leaving taxpayers to fend for themselves with the IRS. So the IRS has started cracking down a lot on false ERC claims, and has instituted a moratorium on new ERC claims. So if you already have an ERC in process, it's okay. But new ERC claims at the moment are not allowed. So our recommendation here is, if you did not use AAFCPAs to file your ERC claim, reach out to your, your advisor at AAFCPAs, because we can review the documents that were submitted in, other records and positions that were being taken for your partial or complete shutdown argument, and, make sure that we think that it is a valid ERC. If it isn't, if you feel like there was some risk here and it wasn't a valid ERC claim, the IRS has established a method whereby taxpayers that have not received their credit yet and feel that they may not qualify, there's actually a way for them to actually officially withdraw their claims and avoid any future hassles and penalties and things like that. So that being said, I will turn it over to our next poll question. So as far as tax credits go, as the year wraps up, which of these golden opportunities are on your radar to explore further?
Thanks, Dave. While everyone's answering that, one item to consider on the employee retention credit is that if you do qualify and have taken the credit, just keep in mind that the income tax return for the year that you claim that credit, you need to amend that return basically to not include the salaries that applied for and you took credit for. So there is a requirement to amend that tax return for the year the ERC was taken, not the year that you got the money, because I think everyone knows it's been a substantial delay in payments from the IRS, and which is only going to be prolonged now because of the moratorium. But one thing that we have been able to verify is that if those salaries that you claim the credit on were non-deductible because of 280E in the first place, you would not have to pick up income for the ERC portion for those employees that you never took the deduction for in the first place because of 280E. So that's just one thing to consider for folks when you do get the refund back and you amend your returns, is that you just keep that in mind. And you can talk to us, and we can certainly help you through that analysis and make sure that the amended return is filed appropriately to maximize the tax savings. And with that, I'm going to turn it over to Josh England, who's going to talk about rescheduling.
Thanks, Dave. So when we start talking about rescheduling, we're really talking about 280E. And over the last 48 minutes, my colleagues have mentioned 280E approximately 23 times. Wouldn't it be nice if we never had to mention 280E again and you didn't have to worry about it? Well, that's what we're really talking about when we start talking about rescheduling. And so, the question with rescheduling is why is it a topic and what happened? So, the U.S. Department of Health and Human Services just issued a letter on August 29th to the DEA, basically recommending rescheduling cannabis from a Schedule 1 narcotic under the Controlled Substance Act to a Schedule 3 narcotic under the Controlled Substance Act. And so what that really means is defining it as under Schedule 1, it has no currently accepted medical use and a high potential for abuse. Whereas under Schedule 3, it has a moderate potential for psychological dependence. It's a big difference. And it's a big difference for you from a tax perspective. It's important to note that even if it does reschedule, both will still be illegal for federal purposes. It'd be illegal to possess, distribute, and manufacture without a prescription. And just going on to the next slide here. So why did the Health and Human Services issue that letter on August 29th? And it was because President Biden, back in October of 22, directed them to initiate the administrative process to review how marijuana is scheduled under federal law. And so there's a lot of rules that go into how rescheduling happens. Basically, what happens is the Controlled Substance Act gives the Health and Human Services the authority to make recommendations to the DEA for scheduling decisions. And the Food and Drug Administration and the HHS are going to conduct a scientific and medical review on that topic. So what happens? The DEA is the agency with the authority to propose a rule that would effectuate rescheduling from a Schedule 1 to a Schedule 3. There are 8 factors that the DEA must consider in conducting this review. These factors range are really scientific in nature and talk about the medical efficacy of marijuana and the potential for addiction. And the DEA really has to defer to Health and Human Services in terms of the scientific and medical matters raised under those 8 questions, those 8 factors, and they're binding on the DEA. So now that the HHS has made the recommendation to convert from a Schedule 1 to a Schedule 3, the DEA now has 90 days to promulgate rules to have that take effect. And so under the Controlled Substance Act, what happens is essentially the DEA will publish new rules, a schedule change in the Federal Registrar, along with reasons for that proposal. There'll be a public commentary period during which people have the opportunity to comment on the proposed change from Schedule 1 to Schedule 3. The DEA will be obligated to review those comments. That commentary period is typically somewhere between 30 and 60 days, but it can be as long as 180 days. The DEA will then have to review those comments and respond to those comments before the rule take effects. And you know, an unusual aspect of the Controlled Substance Act is that the DEA is going to be required to hold public hearings, and where there'll be the presentation of evidence in a courtroom proceeding, and an administrative law judge will then make a decision whether or not the rescheduling should take effect. And it's the administrative law judge's ruling is what will be published in the Federal Register and become effective, typically around 30 days after the judge's ruling does it become effective. So the rules, any regulations, any change here from a Schedule 1 to a Schedule 3 is subject to judicial review in the federal court and a challenge, but that doesn't mean that it would still be in effect while that challenge is taking place. Moreover, there are some hurdles that would have to be overcome in terms of rescheduling. Congress has the ability to review it and pass a resolution disapproving the change. The president would have to sign it, and if they do, then rescheduling wouldn't be able to be looked at again without a congressional approval. Now, it's important to note since 1969, when the Regulatory Enforcement Act went into play, it's only happened once. And given the nature of Congress these days, I doubt that they'd be able to agree on any kind of resolution preventing rescheduling. But the biggest hurdle has to do with a treaty, the Single Convention on Narcotic Drugs, which was the U.S. became a party to in 1961. And that treaty requires that cannabis be controlled in a manner not unlike a Schedule 1 or a Schedule 2 drug. And so it might be against the rules of the treaty that we've entered into to move it to a Schedule 3 narcotic. And moreover, the Controlled Substance Act requires the Attorney General to follow that treaty. So statutorily, it may be impossible for the Attorney General to approve of a rescheduling from Schedule 1 to Schedule 3. It's important to note that that treaty, many of the co-signers have already made cannabis legal on a national basis, among them Canada. So, you know, it's curious to see whether or not that treaty would still be enforceable. Another hurdle is that rescheduling was looked at in 2016. And at that point, the FDA and the DEA, after a significant scientific review, determined that there was no reason to change that. Now, it doesn't mean that agency can't change their minds. Just in order to do that, it's got to be on a reasonable basis for doing so. So if it does change from Schedule 1 to Schedule 3, what does that mean? It means effectively 280E goes away immediately, and you won't be hearing 280E from us at our seminar next year. That's the most significant change, and obviously it's a huge change for the cannabis industry. It really makes the industry a lot more competitive and a much better investment if cannabis operators are operating on the same footing as every other business, which is all they've been asking for. So cannabis will still not be legal on a federal basis. Cannabis companies with plant touching operations in the US will still not be able to be listed on the major US exchanges. That could change. The FDA will assume a more significant regulatory oversight over cannabis. And the restrictions on interstate commerce could change and be subject to legal challenge. Right now, it's all of the individual state laws that prevent that interstate commerce. But you know, if it moves from a Schedule 1 to a Schedule 3, there could be challenges to that. And so we'll just have to wait and see what happens with that. With that, we'll move on to our final poll and see if Dave has any comments on what I've had to say today.
Thanks, Josh. Let's hope that we don't have to talk about 280 next year. That would be great. Just one item with this poll question, you know, this just goes back to great books and records. If your books and records are nice and solid, you know, in addition to making you more tax efficient and have better cash flow management, it will also help you with a potential sale of your company down the road, to have good books and records in place so that the due diligence process does go nice and smoothly. I wanted to thank Tomas, Janice, Dave, and Josh for sharing their insights today. And for those of you on Zoom, thank you for spending time with us today, learning what you need to know. There's a lot to consider when it comes to taxes in this industry, given the constraints of 280E, as well as other regulations and requirements. And we welcome the opportunity to help you map out a tax plan that takes full advantages of all the strategies that may be available to you. Please reach out to your AAFCPA's tax partner or any of today's speakers with any questions or concerns. There were no questions in our Q&A today, but if there's any questions that come up after the fact, please reach out and we'd be sure to help. So again, thanks for everybody for participating in today's webinar, and we hope to catch up to you later on. Thank you.